And there you have it, the end of a very exciting trading week. Hello, investors and traders. I'm AJ Monte, and this is a 1-year daily candle chart of DIA. This is the Dow Jones Industrial Average ETF, and you could see here that we've had a lot of range, at least since the beginning of April. We've had these very long-legged sections of the trend that we call trading legs. And as I zoom in here, you can see that we had a pretty big green candle today, but the big story really is found at the bottom down here in volume. Look at that volume. We had about 25%, almost 30% less volume than what we had yesterday. And so I believe that what we're going to see next week is maybe, and this is a big question mark, maybe we will see a slight rally on Monday and Tuesday, but I think we're going to come right back down as we form an ABCD pattern. You may have heard me talk about the ABCD pattern. You can go back and click on the description box below and you'll see the videos that I put out that pertain to ABCD and some of the role reversal concepts and gap trading and a lot of other topics. So while I think that we're going to turn lower next week, I'm keeping that downside target right there of 395.69. Again, the big signal was that drop in volume today. Now, if we look at IWM, please keep in mind that this is 2,000 stocks, but these are the small cap stocks. If you were to take Tesla and Microsoft or any two of the really big mega cap stocks, for instance, if you look at Apple and Microsoft right here, you can see that both of those stocks total in market cap a little over $6 trillion, almost $6.5 trillion. When you take the Russell 2000 and total up all those stocks, Microsoft and Apple surpass the entire Russell 2000. So it's not very hard for institutions to push this one up. But even with that said, I see a hanging man candle right there on slightly lower volume. Take out your trading checklist. You'll see that we have a wide divergence from the moving average. We have gaps below the market here and here that will most likely act as price magnets. So those downside targets I have here are still in place for IWM as well. That is 208.58. Keep in mind that we also have a negative divergence here. You see how the highs on the CCI and the stochastic are still heading lower as the highs on the Russell are going higher on the price action. That's a negative divergence. Pay very close attention to that because that's exactly what we saw back here. If you see, we had higher highs on the price action, but we had much lower highs on the CCI, and what happened? Boom, we dropped quite significantly from the beginning of May right up until the end of June. So I think we're going to see this whole price action duplicating as we begin to pivot lower in what could be even a double top up here. So we'll have to see. Again, downside target on IWM is 208.58. That moves us to the Qs. This is the only ETF where I think we could see higher prices. Now let me slow down just a little bit here for you. You remember from the last report, we hit that high target precisely, and then we gapped lower, and then we hit this downside target right there as of yesterday, and today we have a half signal. It's hard to see the color of that candle, but if you look straight down at the volume bar, you'll see the color of that candle is green. I have that color coded to match the candle. And so that, by definition, is a bullish harami. We talked about that last week. That is a bullish signal that works out to the upside about 80% of the time. Now, when you take that candle, combine it with the wide divergence that we have from the moving average, known as the rubber band effect, we generally get prices drifting back to the moving average when the price is that far below the moving average. In addition to that, we have a gap right there. 80% of the time, gaps fill. That's not a guarantee. That's just 80% of the time. That also means that 20% of the time, they don't fill. But I think that one will fill because if you look, the moving average is still drifting lower, and that gap fill will coincide directly with that moving average. And I think that we could go all the way up to that level. So I'm going to go up with my target right here and then drop it just a hair below that gap fill. I'm just being a little conservative there at 476.39. In addition to this wide divergence, we had the drop in volume on the way down. That is bullish. We talked about this last night during our equity analysis call with our members. And so when the volume is dropping on the way down, it's telling us that the sellers are becoming less motivated, and that's what the buyers are waiting for before they begin to buy. So once the sellers have finished their selling activity and have sold out of their inventory, the buyers come in and generally push it up. This again was an A to B. Here's the pivot B. We pivoted lower at C, bringing us to a lower D. There you go. Once again, A, B, C, D patterns showing up. Pay very close attention to these patterns because they are money in the bank as far as I'm concerned. If you learn how to read the charts like that, you're putting the odds in your favor. So again, to reiterate, upside target on QQQ is 476.39. That moves me to SPY. That's the S&P 500 ETF. You can see that we had this two-part forecast right here where we are now starting to hinge up on that. That's a half signal, by the way. It's not a full pivot. A full pivot would have been a higher high. We have a slightly lower high today, but we have a higher low. That's known as a half signal. Drop in volume on the way down is bullish. We're very close to a buy signal right there on the CCI, my favorite indicator by far, that commodity channel index. Look it up. It was created by Don Lambert in the 80s. One of the best leading indicators around. If you're not using it, I would suggest you do. And then study it, learn how sensitive it is. It generally leads the signals ahead of the stochastic. So we're just a hair away from that blue line, which is the CCI. Crossing over that green line would be the buy signal, and I think that will happen before the stochastic crosses over the percentile, or that red line. That would generate a buy signal. You can see the buy signal on the stochastic was back here, and we had the pivot long before on the CCI. See, we have the CCI led that buy signal. And so that is where I'm going. I'm going right back up to this high on SPY at 550.63. There is a gap up above the market that will act as a price magnet, but we also have that moving average acting as resistance. That's that roll reversal. Remember, support right here, broken, turns to resistance and could turn again into resistance. The roll reversal is something that I repeat, at least 2 to 3 times a week on webinars. It's a very simple concept that you could draw with a horizontal line, but the principle can also be applied to moving averages. Right? So once the support line is broken in the form of the 20-period moving average, it reverts back to resistance. So that's SPY. Now let's go to the VIX, ticker symbol VIX. You can see here that we already hit my upside target at 1838. That's that green dotted line from last week. And what do we have here? We have a pivot lower on the VIX. A big red candle has a lower high, slightly lower low. So I'm going right back down on the VIX, a slightly lower from where the last downside forecast was. Downside forecast on the VIX is 1523. Now remember, for the most part, the VIX is inversely related to the S&P. So if I'm bearish short term on the VIX, then again, that means I'm bullish short term on the S&P. And we just talked about that, possibly rallying back up to the moving average up there and then pulling back as a pivot from resistance. Now, I just want to throw something out there, you SLV traders. I talked about this last week, and what happened after I showed you this bearish engulfing candle that was engulfing the 3 previous green candles. What happened? Boom, silver gap down and continued lower. Now, it's very, very close to a support level gap fill down here. But like I said last week, I'm still not buying until we get it closer to the 23 level. I have a buy price down here at 22.98. I might even raise that just by a hair. We'll see. But silver is looking more bearish than bullish, especially when you look at the weekly chart. Look what's happened here. The weekly candle, as red as that is, has closed below that 20-period moving average. We haven't seen that in a while, at least from the beginning of the year. So we could see that continue lower in an ABCD zigzag sort of way. And so I'm waiting in cash to be a buyer. I'll let you know when. I'll post that on my X page. For those of you following me on X, all you have to do is put hashtag AJSLV trades, and you'll be notified if you follow me on X when I put the notes out and the times when I'll be buying back in. I let the general public know ahead of me when I'm buying. I actually give it about 5 minutes after I put the post out. I give the general audience to go out there and buy ahead of me. I don't use my influence or my audience on X to push the markets around. I give you, the general audience, the advantage ahead of me. And very few people, if any, do that. So that's SLV. Now I want to talk about our debt. Very simple. Look what's happening here. U.S. national debt is quickly approaching $35 trillion. It's really hard to get your head around that $1 trillion number. But here's some simple math for you. The debt per citizen is over $103,000 for each one of you American citizens. Look at the revenue per citizen. What does not match up here? Well, we're never, at this rate, we're never going to be able to pay off that debt, at least not in our lifetime. So as that clock continues to click away, it's going to put pressure across our entire economy. I want to show you something here. This is the 7-point trading checklist that I make available to the public. If you're interested in a 15-day trial, you can come to StickyTrades.com without the use of any credit card. You could sign up, check it out, kick our tires, look at the webinars. If you like what you see, then it's up to you if you want to enroll as a member. But we don't put any pressure on anybody. If you want to take a screen grab of that, go right ahead. Or you can go to StickyTrades.com and pick it up on the member page. But this is what I wanted to talk about. And I had a chance to talk to one of our clients whose name is Dan. He's a realtor in California. And you can see here, this is from the St. Louis Fed. And this is a chart of housing inventory and the median days on market. What does that mean? This is a very reliable cycle. You can see here that at the beginning of June, almost every single year, what happens is the homes that are listed begin to sit on the market longer and longer as you go through the summer and right up until January. Then what happens in January is the inventories start to drop, houses start to sell, and less homes are out there sitting on the realtor web pages. And so houses start to move. Now, the other thing that you have to pay attention to that's very cyclical is inventory. Look what's happening. And this correlates very nicely to the cycle that I just mentioned. Now, if you look here in the beginning of April and into May, what happens is inventory starts to move up. You see this? Here's the end of April. The inventory goes up. End of April goes up. Here we go. End of April begins to go up. End of April goes up and it continues to climb. And then it starts to top out in the fourth quarter of almost every year. What does that mean? It means that homes are not selling. That's what that means. It's the bottom line. Homes are not selling. They're sitting on the market longer. You can see that a good number of homes, if you look on Zillow, prices are being reduced. They're just not moving the inventory. So that's putting pressure on the real estate market. And if you're a realtor, I got some good news for you. As realtors throw their hands up and they say, you know what, this business isn't for me, I'm not selling any homes, that's when you get rid of the deadwood. I hate to refer to it that way, but you get the weakest realtors that don't know how to sell, don't know how to build relationships. They tend to fall out. And the strongest realtors, the ones that have the persistence and the fortitude and the skills to move homes wind up having less competition. And when the next cycle comes around, those realtors do very well. Now, we have a lot of realtors that follow us at Sticky Trades, and I just want to throw that out because this is a leading economic indicator for sure. Now, I want to talk a little bit about our success. We've had tremendous success, and I'm going to do something that I've never done on any of the weekly market reports. I'm actually going to show you some of our trade blotter for this year. At the beginning of 2024, on January 12th, is when the first trade notification went out to our members. I'm just going to scroll through here. I'm not going to sit here very long. But you can see the green colored cells are the trades that worked out in our favor. So PSLV, which is a silver stock, did very well. And you can see as I scroll down here, the number of green that we have on there, that's money, versus the red of the positions that got stopped out. Now, out of all of these trades that we've put out, we've only had 2 get stopped out. So we have a 94.12% success on the trades. That does not mean a return on investment, by the way. Just understand, this is the percentage of the stocks that went out to our members that wound up making money, right? The most recent one is BHC. I'm kind of giving that away, but the trade is already done, so I'm not giving any secrets away. But BHC went out on July 25th, and you can see this is our publication page, and you can see how this looks. I'm giving you a little bit of a preview of what you might expect if you sign up for a 15-day free trial. It comes out in a text message format, so you get the notification on your smartphone, and then you could go to the website and view the trade and how it's set up, along with a video that explains the trade. So when I play that video, you can go ahead and watch the charts, and you could learn how to manage risk. I put that out to our members, and it's a very, very simple format that you can follow. So again, this is something that might interest you. If you like it, comment on our page right here on YouTube, and I promise you, you're going to inspire others to do the same. So that is the trade that went out for BHC. Our success is, like I said, tremendous, but it doesn't stop there. If you look at the matrix trades, this is for the option traders who go directional. If you go to the beginning of the year, we put out twice as many option trades than we do the equity trades. But if you look here, the first trade went out on January 3rd, and look at that, it was red. That doesn't bother us, because if you scroll down and look at all the other trades, look at how much green there is. We have a winning streak going right now with Intel still in open position, but you see the green are all the winning trades, and we have the red, very few and far between, but the red is where we got stopped out or closed the position. And you can see the most recent one that we've had, one of the most recent ones is Schwab. Look at that. Now, look at the date. That's July 17th. I know I'm giving you a lot of content here, but it's very important that you understand how we work this. On July 17th, we bought the $55 calls for $13.50. Let me show you what happened there. SCHW. And you can see that on the daily chart, look what happened to Schwab after that alert went out right there. We bought on this day with that long shadow, and the stock rallied up very nicely. That turned out to be one of our best trades of the year. And for you members out there, make sure you understand that is a shooting star. Hint, hint. I can't tell you when to sell because I'm not an advisor, but I can absolutely point out the bearish signals when they show up. That is a shooting star, and the volume is dropping on the way up. You see how that works, folks? Well, I certainly love delivering this content to you, and I hope you're learning something, especially through YouTube. If you're brand new, please like. The like button is more important than the comments, actually. If you like, you comment, you share, and you subscribe, that drives the algorithm and helps us build more membership and get more eyes on the videos. And you're doing us a great favor. You're also doing many other people a favor by turning them on to our Sticky Trades channel. It's an educational channel. I try to do my best to deliver that content to you. And with that, I'm going to wish you a great weekend, and I'll talk to you next week. So long.